You were listening to chartingwealth.com for Thursday, the 8th of March, 2018. What you see on the screen, those of you watching via video, we're about to come out with Chapter 8. We are just getting ready to produce it. And in order to get that chapter, of course, you need to be a subscriber to us at chartingwealth.com. We will send that to all of our subscribers first. If you're not already a subscriber, it's easy to be one. Just go to chartingwealth.com, put in your name, email address. This chapter is going to be on our minor indicators. That is the derivative oscillator, the Bollinger Bands, the simple moving average, and the exponential moving average, and how we use them. So please make sure that you are subscribing. We will be putting that out very soon. Let's go ahead and jump into the markets for the day as they closed on Wednesday the 7th as we get ready to head into Thursday the 8th. S&P 500 down just barely 0.02%. We did, of course, have the big down week. That was back in February on the 9th, the week ending the 9th. Market then slid sideways. This last week ending the 2nd was a big red doji, which means lots of indecision tending down. So far for the week, we have a red down candle. Now again, these are a Heiken Ashi average pace candlesticks. Derivative oscillator continuing to gain downward momentum. Price percent oscillator is headed down. That is what we see on our weekly chart as we go to the 2-day chart. We see that the latest 2-day candle in it just finished drawing on the 7th. Actually, it appears that the price percent oscillator tends to be sliding sideways. Looks like it's probably moving up a little bit. We've had the price action just push through the weekly trend line as far as the green candle goes. But again, if you look at that candle, you can see that it stopped right about where the prior candle ending on the 5th started moving down. So we'll continue to watch derivative oscillator losing downward momentum. Hasn't switched over positive yet, but we're still watching that, seeing what's happening. As we look at our 50-period moving average, that's a simple moving average, we can see where it provided sort of a base for things to bounce off of, going all the way back to the 13th. And in fact, in that new chapter, we talk about how you use the simple moving average on both the 50 and the 200 as potential support and resistance lines. Here it was, of course, a support line. We'll continue to keep our eye on that. Now, as we continue to move ahead from the 2-day chart, take a look at the 4-hour chart, we can see that it is struggling to move through, that is the price percent oscillator, to move through the red signal line. Derivative oscillator has gone positive, but again, we've really seen a sideways slide. We have a fight going on, my friends, right now as to whether this market's going to go up or down. Now, as we look, though, out at, and remember, all things being equal, markets tend to move in the direction of what? You hear us say this all the time, the largest chart. Largest chart is down. Remember, we kicked the stops out of the market. We took the house that the market was built on, and back on the week ending the 9th of February, it's like tearing out half the foundation, because all of a sudden people realized, man, this market can really suck wind and go down, which it did. Sort of sent some shudders in. What's happened? Did it recover since then? No, it's been sliding sideways since then. And so far this week, our average pace candlestick shows us that it's down. So again, we'll continue to monitor and watch that. Market's trying to recover, but we can see from where things are on the 4-hour chart too, it's struggling really hard to do that. We have the 50-period moving average line on the 4-hour chart that it has pushed through just barely, but it's holding up on pushing through that weekly trend line. We can see where things bounced off the 200-period moving average back on the 2nd. And again, that is the 4-hour chart. Remember, all these charts, each of them have a 50 and a 200-period simple moving average, and those things are powerful and important to pay attention to. We have exponential moving averages at the bottom of our charts where we can see price movement. And again, those of you who know the difference between exponential and moving, well, in fact, I'll leave that for Chapter 8 because we explain that. Let's keep moving through these charts. We're going back to the weekly, moving on to the Qs. Now, the Qs was up for the day. Whereas the S&P 500 down 0.02%, the Qs was up 0.23%, actually going into the third week of up movement after, again, that big trauma and down move for the week ending the 9th of February. The Qs has almost, I mean, it's really right at the point where it started moving down on our average pace. Candlesticks are Heikin-Ashi. Derivative oscillators actually losing some downward momentum. Price percent oscillator appears to be poised to move up. Now, as we look at the 2-day chart, what do we see? Well, the 2-day chart has now crossed over officially because this candle completed drawing on Wednesday. So now we have real schizophrenic condition. We have the weekly chart down and the 2-day chart up as far as the NASDAQ 100 goes. So again, that pretty much means you're not jumping into any trades at this time, and we've seen it be wishy-washy and sliding sideways as far as our price percent oscillator goes over the last many days. And as we look at that 4-hour chart, what do you see? 4-hour chart's trying to cross over, going up. It's pretty close. If it's a down morning, of course, it'll easily pull the blue price percent oscillator back over to negative, but the derivative oscillators in the positive also. So again, don't have a trade there in the Qs, and particularly with that 2-day chart crossing over, going up, it's taken that away from you. And again, never had a good clear entry point because of the movement back and forth with the 2-day, that is the 2-day chart, the 2-day price percent oscillator. But again, on the S&P 500, it's been, of course, much stronger with that down move. Let's go back to TLT, see what it's doing. Remember, as things have sort of gone sideways in the market, the stock markets, bonds, which are typically a safe haven where money runs to, when the market's going up, typically bonds as a safe haven are going down because you don't need a safe haven when the market's going up. But when the market's going down, bonds tend to go up. Well, as we slide sideways, then we would expect bonds, of course, to slide sideways with the market, which we've seen over the last couple of weeks. Of course, bonds had a 4-week just, well, actually, what, about a 7, 8, maybe even 9-week down move. Of course, we had that weekly vertical crossover back on January the 5th, still in a weekly vertical crossover going down. And we see, though, that the 2-day chart has rotated over. Back on the week ending the 2nd of March, we had a green spinning top, indecision tending up. So far this week, we have a red down candle. So we see the derivative oscillator, however, is losing downward momentum. Price percent oscillator not moving down at the same strong angle it was way back in early February, but still moving down nonetheless. As we look at that 2-day chart, what do we see? Well, of course, it crossed over on the 5th. 2-day chart ending the 5th, and of course we're now into this next 2-day period of up movement technically, but really a sideways slide, still trying to figure itself out. The bonds are, and again, don't have a trade because the weekly's down, the 2-day is up. And as we look at the 4-hour chart, we can see that it appears to be trying its best, particularly the way things ended the day, indecision tending down. We have the price percent oscillator heading down. Derivative oscillator has been in the negative for 3 periods, so that's a day and a half. So again, interesting. Might see things continue to roll over and head back down on TLT. So we'll just keep things posted. We'll let you know what we see happening. Now, lastly, we go to gold. What is gold up to? Down for the day, 0.64%, our biggest down chart for the day. Looks like gold is getting closer and closer to crossing over, going down on that weekly chart. Derivative oscillator, of course, is in the red right now. We'll see at the end of the week what we have. Of course, right now, the candle itself is a green up candle. It's a very little up candle, means lots of indecision, but tending up. We look at the 2-day chart in gold. It ended with a green open box. That's a strong up candle, not as strong as those candles back on the 2-day chart ending on the 16th, the 15th, and then the 16th. And then, of course, we had 4 2-day candles heading down. And right now we've seen movement push through the weekly trend line, and still, however, even with that movement, derivative oscillator still heading down, price percent oscillator still in the negative on that 2-day chart. So we'll just keep watching and seeing where the market leads us in gold. Again, you know, it's and our 4-hour chart is not looking so good for us. We had basically a day of up movement on Tuesday, and then Wednesday down movement, actually pushing through that weekly trend line at the end of the day. We keep hoping that this 4-hour chart is not going to go south on us again and is going to start giving us some good trending. Hope is not lost. We've not had a crossover going down yet. We'll wait and see if gold recovers and continues its upward flight after the crossover going up back on the morning of the Tuesday the 6th on the 4-hour chart. That's where we are as we end the day on Wednesday, go into Thursday. Like we said, new training going to be coming out pretty soon. If you are not already signed up for our daily market reviews, you need to go to chartingwealth.com and do so. And again, keep doing your practice trades. Keep up with your weekly and your daily market worksheets. All of that is available in the email that we send out every day to our subscribers. You get those PDFs. You can print out those sheets and start creating your own trader diary. You need that. You need that because it is worth its weight in gold. Helps you master charting. Thank you again so much, my friends, for making us in the top 10 in the world as far as stock market podcasts go, top 5 in the world for stock trading podcasts. We sure appreciate it. We'll continue to pump out this valuable information to you every day that these markets are open. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.